Last week, silver crashed by over 30%, which is a crazy move in a precious metal stock. And in fact, I was able to capture gains on a few of the stocks that actually were down from where I bought them because I followed a rules-based systematic trading approach. Now, I am a professional investor. All of my trades this year are linked in a Google Sheet down below, as well as my full trading plan, which we'll, of course, dive into. Is linked down below as well. There is no paywall. There is no anything. You click it, you got it. It's just that fast. And we're going to watch this video together talking about how important it is to have a rules-based stock trading strategy designed to simplify investing. I could not agree with this anymore. We're going to be playing bingo as well. We're going to be giving away all kinds of merch, but only if you put hashtag outlier in the chat right now. So let's go.
Per year to manage, yet it's beaten every single UK fund manager over the past decade. A strategy that turned £100,000 into over 340,000 against the FTSE All-Shares 127,000. In this video, we will cover a system so effective that it has outperformed the S&P 500, a growth market index, using only the value-driven UK stocks. The system is Stockopedia's Knaps or NAPS portfolio. It's something that challenges everything that you think you know about successful investing. While most...
Okay. Before we get into this, I actually want to hear from you. What are some things that you have learned that challenges the conventional wisdom of investing? For me, I'll tell you exactly one thing that was a big light bulb for me is, you don't have to know what's going to happen in the future. Man, I remember very specifically being at the beginning of my trading career and being like, man, I want to trade stocks, but I don't know what's going to happen in the future. I have no idea what's going to happen in the future. But the funny part about that is how you become successful. It's by just embracing the fact that you don't know what's going to happen in the future. You don't have any idea what's going to happen in the future. And because of that, that is actually how you can be successful. Carol Catherine, who makes all the monies, way to go, Carol, averaging up, right? Buying stocks as they're crashing up, not buying as they're crashing down, right? And think about it logically, right? Don't buy the dip, buy the rip. If you don't, let me rephrase that. Don't buy the dip because you don't know how far it's going to dip. And by the same logical reasoning, buy the rip because you don't know how far it can rip. But then I have to pay more for it. Yeah, you do. That's because everybody else wants some of it. And don't you want to be buying it as it's going up and not as it's going down? Yeah. Or David right here, losers average losers. Losers average losers. Man, that sounds really profound, David. Wonder where you could have heard that from. Maybe one of the greatest traders ever, Paul Tudor Jones, had that stapled to his wall. Losers average losers. Yeah, well said. Mikey Mike, the market maker. When am I getting out? Yeah, it's so fun and sexy talking about all the entry points. But where in the wide world of sports do you plan to get out? Right. Profit targets. Brian, Mr. Anxiety. Having a profit target. Yeah. And that emotional anchoring to a profit target, right? I'm sure that there are SoFi bros who have said, SoFi is going to go to $75 a share. That way the CEO can get all of his bonuses. And right now it's less than a third of that. And you can anchor yourself to that point. Hang on, let's just draw $75 a share on the chart right here, right? So SoFi is going to $75. Well, by all means, it totally can. And I'm not saying that it won't. But what I'm saying is, if it doesn't, do you just plan to be an investor forever? It's the future of finance. So of course I'm going to buy it. It's a full moon today and it looks like a full moon way up here. And that's about how far it's going to have to go up in order for SoFi to hit your profit target. Let's keep going. These are great. Long-term buy and hold doesn't make sense. I had somebody send a outlier support email asking about Tesla. Hang on. I want to go into that real quick. They asked about Tesla specifically on performance summary. And so here, what I want to pull up on the performance summary, buy and hold 695%, outlier buy and sell signals 1326, so nearly double, right? But where I wanted to go with that is when you look at any stock, right? What's cool about outlier is you can drop in here and you can do an instant back test on the outlier buy and sell signals versus buy and hold. But if you buy and hold, you're literally throwing a dart and keeping it on the dartboard and saying, okay, I'm betting everything on this guy for the next 5 years, for example. versus I'm going to have a systematic approach. I'm going to have a plan to get in and out. I'll buy it as it's crashing up, leave it off my portfolio as it's crashing down. Whereas buy and hold is, man, I hope I picked the right one, right? Let's just pick another one at random, right? Let's go to Coke, KO, Coca-Cola in the staple sector. I have no idea what it's going to be. Okay, outlier 7% versus buy and hold at 41%. Again, 7% using rules-based trading. Buy and hold, you just happen to find one that worked. Okay? Do you see the difference here? Yes, this is less. I'll give you that. But it also is in the market 36% of the time. So the other 64% of the time, you can do anything else in the world you want. And you still came out with positive expectancy. Whereas buy and hold, you just happen to get lucky. Let's keep going.
Investors spend hours researching companies, reading annual reports, and following
just trying to do that.
Market news. There's a mechanical system that's been quietly crushing the competition. The Knaps portfolio, derived from Knap hand, like having an unbeatable hand in cards, has compounded at 13% annually for 10 years straight.
13%'s nothing. Let me get Derpy Joker out. A consistent 13% compound annual growth rate is actually fantastic. That's awesome.
But here's the kicker. It's so simple that anyone can replicate it. By the end of this video, you'll understand exactly how this system works and why rules-based investing might be the key to building long-term wealth in the UK market.
Or in any market, right? Don't get construed with the whole UK thing. And if he does have some excuse me, if he does have some UK idiosyncrasies, that's okay. The principles to be successful in any market apply to every market. I3, Stefan says I3, follow your plan. Damn it. Daggum. Fine, Stefan. We'll get it on the board, my friend. I know what Stefan's after. He wants a hoodie.
Let's start with the foundation. What makes Knaps different? Let me start with a story that perfectly illustrates why most investors fail. Picture this. You buy a stock based on a compelling story, watch it double in value, and then hold on because you believe in the company.
Sounds like SoFi, doesn't it? Buy a stock because it's the future of finance, bro. Watch it double in price, right? From around $7 up to $15. There's no way this can ever go down, bro. Even though a random guy on the internet was specifically at this exact time saying, don't buy SoFi as it's coming up in this order block. Wonder what happened after that point. Just curious. Oh, it fell by 53%. Stocks that have huge runs like this fall into the 50-80 rule. 50% of the time, they can fall by 80%. 80% of the time, they can fall by 50%. And just because the stock has made this huge run does not mean it will continue. Now, did SoFi? It did. See, told you, future of finance. I did all my fundamental research here, which you don't have to do because all that fundamental research is not going to pay you until the price is actually going up.
Sound familiar? The Knaps system would have sold that stock after exactly 1 year, regardless of the story. And here's the shocking part. Of the top 10 biggest Knaps winners over the decade, 8 of them either crashed or went sideways after being sold. Only 2 continued to rise significantly. This is the fundamental difference between emotional, story-driven investing and systematic, rules-based investing.
Systematic, rules-based investing. This is exactly where you as a professional investor need to end up. Emotional, story-driven investing is why 90% of people blow up 90% of their accounts the first 90 days of trading. You get to make the choice. I got a great feeling on this stock. That's fine. Have a fantastic feeling about the stock. And then once it hits those rules, then it can be a fantastic investment because you have such a great feeling.
The Knaps portfolio doesn't care about your feelings, market sentiment, or compelling narratives.
Wait. He's not going to say it, is he? I'm not going to say it. I have a cease and desist order against me for saying it. Okay. I'm not going to say it, but I'm not going to stop you from saying it. Okay. I didn't say it. But the only time you're going to get paid is if the price is going up. I don't know what would I ever say that would get me in hot water with a cease and desist order. I can't say anything like that, but you certainly can in the chat.
Follows a simple set of rules that have been proven to work over decades. Here are Knaps' 3 pillars of success. The Knaps strategy is built on what Stockopedia calls the 3D framework, 3 dimensions that separate winning portfolios from losing ones. First, drivers, consistently picking high potential shares. The system uses Stockopedia's proprietary stock rank, which combines quality, value, and momentum factors. These aren't random metrics, they're the 3 most powerful return drivers proven by academic research over the past century. Second, diversity, reducing risk while improving returns. Instead of betting everything on a few stocks,
Hang on, I'm going to give you something. We haven't put anything on the board for a minute. Reducing risk while increasing returns. This is exactly what I'm all about. G2, momentum. I'll give you momentum. I don't remember him saying it, but then again, you guys are way smarter than me with my itty bitty baby brain, so I'll give you momentum. Pop slap pat says G5. Yeah, for sure. I'll give you G5 all day, baby. All day. There we go. That's a good one. What else? What I miss one? Manny runs the bingo board, by the way. This is Manny's bingo board. We just get to play on it. High probably set up an 01. Yeah, why not? He's had enough. I'll tell you when I've had enough. You can't tell me when I've had enough. It's Mr. Had enough every Friday night at the bar.
Knaps spreads risk across all 10 market sectors. This isn't just about safety, it's about ensuring you capture the next big winner wherever it emerges.
You mean by letting your winners run? I agree.
Third, discipline, maintaining your edge through time. This is where most investors...
Discipline? I just choked on my coffee on that one. There we go. Consistency / discipline, right? Now, this is an important thing. This is something that Richard Dennis, who created the Turtle Traders experiment. So the Turtle Traders, this was in the 80s. Basically, Richard Dennis had a wager with his business partner that says, I can teach anybody to trade. And his business partner was like, no, traders are born with it. There's no possible way that you can teach people how to trade. And Richard Dennis was like, hold my beer. Hold my beer. Let me show you how it's done. So he basically got people specifically with all different walks of life, right? He did not want PhDs. He did not want people who had traded before. He found people from all walks of life and taught them the rules to be successful. Dude had made $290 million by the time he was 29 years old. Okay? He knew what he was doing. Now, he says, I say you could publish the rules in a newspaper and nobody would follow them. The key is consistency and discipline. And I'm feeling like that lately too, right? I give you guys the rules twice a day, every day, live here on YouTube. I show you the trades that I'm taking. Yet still, I get people come back saying, Chris, you know what you're talking about. Chris, no, I followed your plan to the T and I'm down 18%. And it's like, well, then you didn't follow it to the T. I'm feeling this more and more lately, right? Everything that you could ever want to know to be successful on the internet is out there, specifically on this channel. Be sure you subscribe. It's up to you to actually make it happen. It's up to you to actually make it happen. Chris P is a manager of funds. Chris P said that. I taught him how to trade. You're welcome, Chris P. You're welcome. Let's keep going.
Investors fail. They start with good intentions, but let emotions drive their decisions. Knaps eliminates this human weakness entirely. Let's cover the complete Knaps methodology. It's so simple that you could implement this yourself in minutes.
Okay. Since it's so simple, what do y'all think it is? I have no idea. I literally don't know. I like to watch these videos blind so I can do it with you. I would say, number one, you're looking for price to be moving up. That's the first thing. Number two, I think it's letting your winners run and cutting your losers short. That's the second thing. And if it's that simple, I mean, that's what I'm thinking. 10 over 20, price over 50. Manny, if he says that, that would be so sick. That'd be so sick. Manny, here's the deal I'll make for you, because this is Manny's bingo board here. Manny, if he says specifically 10, 20, and 50 moving averages, just those three, I'll let you pick anything you want in the store. Just for Manny. Only brisket pays. That's right. Only brisket pays. Okay, let's keep going.
Step 1. Sort the entire UK stock market by stock rank in descending order.
Okay. I would bet, because no trading on me. I think your name is Paul, right? Right, no trading on me. Yeah, it's definitely not sell put spreads and take 50% profits. No way. Sort the entire stock market by, I guess, a specific stock rank in descending order, which would be like 100 to 0. Okay, so we're trying to find the best stocks by whatever that stock rank is ranking them by. Let's keep going.
This ranks every stock by its combined quality, value, and momentum characteristic.
There you go. So they had a very quick graphic of what these things were, but in a nutshell, we're trying to find the best stocks. Okay, the best stocks.
Step 2. Exclude small, hard-to-trade shares with market caps below £20 million. We want liquidity.
No crap. No crap. You always want liquidity. Manny, we're not there yet, dude. We're not there yet. There's a chance. You still got a chance, Manny. Exclude hard-to-trade shares with market caps below 20 million. Now, for me, whenever I look to trade, I come into OVTLYR and I go to my screener. And then I filter for, I want to make sure it has at least 1 million average daily shares. At least 1 million average daily shares. This says market caps below 20 million. That's also something you can filter in OVTLYR as a market cap. I just leave it wide open with lots of liquidity. That's how I live. Because if it's hard to get in, it will be impossible to get out. Impossible to get out. Let's keep going.
Step 3. Select the top 2 stocks from each of the 10 market sectors. This gives you a diversified portfolio of 20 stocks. Step 4.
That's interesting. So not all sectors are the sectors to trade, right? In fact, if we go into OVTLYR real quick, I want to look at the sectors. So let's go to market breadth, and then let's pull up the summary button right here. And this will show us which sectors are on fire, right? Like the energy sector, absolutely on fire. Staples and utilities are also on fire. Those are, and communication. Communication actually has like Google and Netflix and a few of the other big tech stocks that you're aware of fall into communication. Meta falls into communication. So yeah, those would be the sectors I would be interested in, right? I wouldn't just buy all sectors blindly because I mean, like, if of the 11 sectors, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Wow, it's like I know what I'm talking about. Of the 11 sectors, only 4 of them are actually working right now. So I wouldn't even touch the others, but that's just me. Let's keep going.
The entire list and hold for exactly 1 year. And step 5.
Oh. I don't know about that, but okay.
After 1 year, sell everything and repeat the process.
I don't know if I can get behind this. Now, there are definitely some good points here, but this is not a strategy I'm willing to put my money behind. Last chance, Manny. It looks like you get nothing. Wait a minute. I know what Manny gets.
It's all there, black and white, clear as crystal. You get nothing. You lose. Good day, sir.
Sorry, Manny.
That's it. No complex analysis, no reading annual reports, no following CEO interviews. The entire process
This I can get behind.
takes less than an hour annually. But why does this mechanical approach work so well? The answer lies in human psychology. We're hardwired to make investing mistakes. We fall in love with stories, we panic during crashes.
This is so true. To be successful in trading, you have to break normal basic human psychology. And that is extremely hard, of course. Exceptionally hard, of course. If you can do this, then you can be successful in the market. Most people can't.
We chase hot sectors and we hold losers too long while selling winners too early. The Knaps system eliminates every single one of these biases. It doesn't care that a company has an exciting new product or that the CEO gave a compelling interview. It only cares about the data.
Oh, yeah. We're going to give you a mindset on that one. Faux show. Let's keep going.
And the data doesn't lie. Consider this. The system picked Games Workshop when it was unfashionable, rode Jet 2's incredible run, and captured IQE's 261% gain in 2017.
Surfing Bird said, I did not say it. I didn't say it. Okay. Can't send me another cease and desist when I didn't say it.
But it also sold Petropavlovsk before it crashed 96%, exited Frontier Developments before it fell 94%, and got out of IQE before it collapsed to 93%.
I don't know about that. I think those are some decently cherry-picked examples because remember, in this rule set, it said hold it for a year, period. Okay, what if you were holding it right here? What if this just happened to be the time where you buy it right there? And it goes, you're down 50%, right? Yeah, those are definitely some cherry-picked examples. That's okay, let's keep going.
A human investor attached to these winning stories would have held on and watched their gains evaporate.
In the market cycle. Rick Warfish. I think we need a market cycle song.
Now let's talk numbers because the results are simply staggering.
Yeah, I'll give you market cycle. Who said B5? Sheetal said B5.
Over the past decade, the Knaps portfolio has delivered a 241% total return, compounding at 13% annually. To put this in perspective, £100,000 invested in 2015 would be worth over £340,000 today. But here,
in case you're ever wondering, right? It's you take your original investment times what the return is, so 241%. Okay, so 100 times 241 gets you 241. But then you add back the original investment. That is how you get to that number. I don't know if anybody's ever explained that to you, but that's how you get there.
Here's what makes this truly remarkable. This performance was achieved during one of the most challenging decades for UK stocks. We've had Brexit uncertainty, 6 different prime ministers, a global pandemic, and a torrent of companies delisting to move to the US. The FTSE All-Share,
moving for freedom, baby,
managed just 27% over the same period. Even more impressive, the Knaps portfolio beats the S&P 500's 193% return using only UK stocks. While everyone was saying you needed to abandon the UK market, this simple system proved them wrong. What's particularly fascinating about Knaps is how it captures multi-baggers, stocks that multiply several times over. The system identified 13 stocks that doubled during the decade, with 2 almost quadrupling. Games Workshop delivered a staggering 269% gain, while IQE returned 261% in a single year. But here's the crucial insight. The system's discipline saved investors from devastating losses. Of those top 10 winners, 4 crashed by more than 90% after being sold, and 4 more went sideways for years. Only Games Workshop and Premier Foods continued rising significantly after exit. This proves that having an exit strategy isn't just important, it's essential for preserving wealth.
There you go. Okay. Exit signals all day. All day. All right. In forward, don't predict. I don't know, quick pass. Sounds like you're trying to sell me a toll tag. I don't know about that quick pass. Fine. Wait a minute. Manny's running the board here. G4. I got it, Manny. I got it. But you know what? Let's give it to quick pass. I'll give him N4. Don't predict. That'll work. Steven Davidson says 03. 03. I don't remember him saying that. Manny, do you remember him saying 03? I don't remember that.
Let's now see how the strategy fared against the competition. When Stockopedia downloaded data on 175 UK-focused funds with 10-year track records, the results were eye-opening. The Knaps portfolio beat every single one of them. Not most of them, all of them. This isn't just about beating the market. It's about demonstrating that individual investors, using simple rules, can outperform professional fund managers with their teams of analysts and resources. The win rate tells the story perfectly. The Knaps achieved a 57% success rate, meaning 57% of individual stock picks were profitable. Combined with a payoff ratio of 1.91, where average...
Look at this expectancy. All right, let's run what expectancy is, right? Let's run the expectancy on this. Because we got all the data we need right there. Expectancy is, think of it this way, right? If you flipped a quarter, right, an American freedom quarter, and every time that you won $1, okay? But every time you lost $1. Your expectancy would be 0 because it's a 50-50, right? But you understand that in the first 5 flips, you possibly may get 5 heads in a row, but you also may get 5 tails, so 5 losses in a row. Very possible. But imagine if you took that quarter and you weighted it on one side, so it would land on 51% of the time on heads, 49% on tails. You would flip that for the rest of your life because you would be a trillionaire, right? That would be the expectancy and how that changes. So let's calculate expectancy here. Expectancy. So you need your win rate, your loss rate, your average win, your average loss. Okay. Now this is Finance Bro Chris talking, so I might go a little fast, but I'll try and explain everything. Win rate here, 57%. Loss rate equals 1 minus that, 43%. Okay. Average win, 44%, which is actually really huge. Average loss, 23%. Okay. Now the formula equals your win rate times the amount of your average win. And it doesn't matter if it's percents or dollars, it still gets you the same spot. Minus your loss rate times your average loss. That is how you calculate expectancy. So the expectancy here is 15.9, so 15.19. So that doesn't mean every time they put on a trade, it'll be a 15% winner. But what it means is, given enough occurrences, on average, the bottom number, average result, is a 15.9% gain across every one of those trades. That is actually huge. That is a tremendously high, hugely bigly expectancy right there. That's actually really cool.
Average winners returned almost double the average loss. This created a powerful compounding machine. Here is how the strategy approached sector diversification. Think of your portfolio like sailing a ship. You need anchors to weather storms and sails to catch favorable winds. That's why Knaps invests across all 10 market sectors. You might look at...
So I guess in the UK they got 10, but in the US they have 11. But again, not every sector is worth investing in all the time.
the performance and think you'll avoid telecoms or energy, but there have been significant periods where these sectors dominated returns. The beauty of the system is that it doesn't try to predict which sector will win next. Instead, it ensures you're positioned to benefit from whatever rotation occurs.
Steve asked a great question. Is expectancy the same as proven edge? It's one and the same. They are exactly the same. Yes. Senior Wahoo says 03 for sure. Okay, fine. Okay, fine. Art is one of our OVTLYR University students. What in the wide world of sports is OVTLYR University? Well, I'm glad you asked. Once I find the button, I need to add this to my stream deck.
Are you ready? Let's go!
Respect is earned. Respect is never given.
OVTLYR University is our way to give back to you. It is our complete trading course for absolutely $0. There is no paywall. There is no masterclass. This is everything that I've learned in 17 years of trading put together for you. Now, the way to access it is to go to whatever channel you're watching, on my channel, the OVTLYR channel, etc. Go to the playlist tab. You'll see the OVTLYR University Bravo and OVTLYR University Alpha. This is a group of students who have actually gone through class live, been able to ask all the same questions that you have to find out how to be successful. Now, here's the thing, right? Here's the thing. 50% of you are going to listen passively. You're not going to do anything with it, and you're not going to change your lives. 25% of you, like I mentioned earlier, you're going to listen, you're going to screw it up, and you're going to come back and you're going to say, Chris made me sell my SoFi shares, which has happened. Which is why we continue to make that joke, because it actually has happened. Then 25% of you are going to listen, you're going to implement, you're going to understand expectancy, how to be successful, how to create your own trading plan, and understanding that losses have to be built into your system. And then you are going to be one of the 25% who build generational wealth. It's up to you. It's up to you to make that happen. Let's finish this up here.
One year's sector winner often becomes next year's loser, and the Knaps diversification approach provides both resilience and returns. More recently, the strategy's performance continues to be robust. Even in 2025.
Okay, this is important. Having a robust strategy. You want a strategy. You want a trading plan that will work in all market conditions, that's when it's called robust.
The system keeps delivering. In the first quarter, the Knaps portfolio hit new all-time highs, up 7.3% year to date, while the FTSE All-Share managed just 0.6%. The portfolio weathered the March month turbulence and rebounded strongly, proving once again that systematic diversification works. What's particularly interesting about Q1 2025 is how the biggest winners came from unexpected places. 2 junior gold miners, Metals Exploration and Sarabi Gold, led the charge, while retailers like Kingfisher and Currys surprised to the upside. Meanwhile, the stocks that performed worst were U Group and Journeo, ironically the ones the portfolio manager knew best. This perfectly illustrates why removing human bias and sticking to the system works. Stockopedia.
Now, and here's the thing. You don't have to run this system. This is an example of a stock trading system. What you have to do is create a system that has an edge. Whatever that edge is that you have created, that is what you need to run, and that's what you got to do, right? And in fact, that's one of the things that we talked about in OVTLYR Bravo, or OVTLYR University Bravo, is making your own trading plan, right? I don't care what it is. I really don't. That's up to you, right? I'm not going to tell you the best way to trade because like what works for me and my personality is going to be completely different that works for you and your personality. And you have to build a personality style of trading that fits you and your portfolio, right? That's totally up to you. So listen, if you have not already put #OVTLYR in the chat, you're going to miss out because we are about to do giveaways here in just a moment. So #OVTLYR in the chat if you want to win bingo. If you want to win bingo. I mean, if you don't want to win bingo, then don't do it. If you've already put #OVTLYR in the chat, there is a possibility that it didn't recognize it in the system. This is engagement baiting on purpose to make sure that you are in the system. So let's keep going. Let's wrap this up.
It has also launched a more dynamic version called the QVM portfolio that builds on Knaps principles but allows for more responsive systematic changes throughout the year. Early results show similar performance, validating the core approach while exploring evolutionary improvements. But let's be honest about this.
You know, before he goes too far off that, that's something that I'm a huge advocate for is finding ways to improve my plan. In fact, Cam, who I did see here earlier, what's up, Cam? Cam and I are working on a little project together on the options side, which is coming up with a theory and testing that theory of is there a certain number of days that if an option hasn't moved X% that we need to go ahead and get out. And also testing the theory of the option strike liquidity. One thing that I have found, which is really interesting, when I was trading on my own without anybody watching, which was ironic because I had made 2,000 videos with nobody watching. And then over the last year, everybody started watching, which is wonderful. I'm super glad you're here. My rule of thumb for liquidity was just 250 open interest or greater. Now, at the same time, we're probably getting, I don't know, but I imagine 8 figures of people trading into the exact same position that I used to be trading on my own. And 250 still seems to work. I have not come across anybody who says, I can't get in, I can't get out. So I think there may be more workings under the surface that I want to explore. So, but that's also the market maker's job, right? If somebody wants to buy an option, they got to be able to provide that option for liquidity's sake. So I don't know. Still something I'm working on, but to that point, it's evolving, right? The plan is evolving with the sole purpose of creating a greater edge. Now, even if I don't change my win rate, loss rate, average win or average loss, what I'm doing by looking at the options, right, is giving myself more opportunities. And remember, like we talked about flipping the quarter earlier, the more opportunities you hit, the more times you get to win, right? The more your expectancy comes through. So if I were taking, for example, if there were 20 potential trade setups in a single day, and it took 4 of them because the other 16 didn't fit my liquidity requirements, but through our research, and we found that 10 of them actually would fit our liquidity requirements. I went from 4 to 10. That means I have 2.5x the number of trades that I could put on. And if I have a positive expectancy, what do you think will happen, right? Expectancy times frequency equals outcome. So let's look at this, right? So let's look at this. If we had frequency FQY of 4 and then FQY of 10, right? We have the same expectancy here. The edge is still the same, But instead of being 4 times 10, I'm sorry, 4 times that should be a 60% gain. Let me lock this down real quick. Lock down the C4 or C8. There we go. Instead of 4 times 15 with the 61% gain on average, right? We could look at that. Ah, now I see why Chris cares. Now I see why Chris is doing this, right? If my frequency went from 4 to 10 only because of having more opportunities, not by changing my expectancy here, but by changing my frequency, this is where you get to outcome, which is frequency times expectancy. Pretty cool, right? Pretty cool. All right. So you know what else is pretty cool? A lot of you have put hashtag outlier in the chat. Not everybody. Only about half of y'all have. So the smart half of y'all that are watching, let's go ahead and oh wait, we don't have any bingos. Sorry, never mind. We're not gonna draw any bingos today. My bad. All right, bye. Have a great day. You think I would do that to you? Do you really think that I would do that to you? Of course not. Of course not. I wouldn't do that to you. I wonder. You know, one thing that I talk about is that I want to make sure that I'm finding the best sectors, not just any sector. I want the best sectors, the mostest, bestest sectors. And those sectors are going to have strong breath. They're gonna have that coffee breath. I don't know about you, but I drink a lot of black coffee. And my wife lets me know all the time how bad my breath smells. I got the strong breath, right? But in the sector, we want strong breadth. I don't know. With my Texan accent, it may not come through. All right. But listen, you will not get paid. It is a fact. You will not get paid unless the stock is trending up. Like, assuming you're going long, assuming you're buying the shares. You will not get paid unless it's going up. So you'd have to follow the trend. I don't want to move the entire board. I just want to move this. You'll have to follow the trend for it to go up, which means you'd have to have a bingo, baby. Let's go. All right, first bingo on the board. Very cool. Would you ever say use a stop loss? Well, of course. Of course. You'd have to use a stop loss like our wizard Nick. Wizard Nick says use a stop loss. That's a brilliant idea, Wizard Nick. How about a bingo, baby? Oh, okay. But listen. We got 1 bingo. We got 2 bingos. Who's the president again? Who's the president again? Who's the guy with the golden toilet tweets that, like, you know, 75% of the time never goes in the direction you want to see? I'm pretty sure that someone said winners trump losses. Yeah, I agree with you. Winners trump losses. And anytime we get a Trump on there, that is an automatic Trump bingo, baby. There we go. Now, that's not to be political. It's just funny because at all times, there's always the risk of a golden toilet tweet coming out against us. And that brings us to 3 bingos. 3 bingos. But only for those of you who put hashtag outlier in the chat. Only for those of you who put hashtag outlier in the chat. And let's see who the first winner is. Let's see who the first winner is going to be. First big money bingo winner of the day is hey, there's Wizard Nick. Patrick! Congratulations, Patrick. Patrick's won before. I remember seeing his happy smiley face right there. Congratulations to Patrick. Let me draft up my email that I'm going to send over to Cheryl and April. They are 2 customer service people. And let me put that Patrick has won. April and Cheryl will verify that you are in fact Patrick. And let's see what Patrick has won today. This is the merch Wheel of Fortune. Everybody got hoodies, Patrick. Let's see if you get hoodies again. Let's see. An 80 Delta koozie. Let's go look at that real quick. So go over here to the 80 Deltas. And you can see that Patrick has got a nice 80 Delta koozie for his beverage. So where did Patrick go? Giveaway tool. There we go. There you go. Now Patrick can put the 80 Delta koozie around his blue Solo cup. There you go. 80 Delta koozie. Congrats to you, Patrick. All right, let's see who the next winner is. I wonder who the next winner is going to be. Maybe it's you. Maybe it's you. Let's see. Maybe it's you. Maybe it's Maybelline. Maybe it's Sabrina. A girl? What is happening right now? No girls watch this channel. It's 92.2% men who watch this channel. Congratulations, Sabrina. All right. Let's see what Sabrina's won. Let's see what Sabrina has won. Sabrina has won a slingshot hat. Outstanding. Let's go look at that slingshot hat real quick. Slingshot hat. Let's see. Slingshot hat. Hey, that's a good looking hat. I remember helping put that design together. I suggested putting the outlier below the slingshot because of the way that it works. You wouldn't be able to read it like you would in other places on the other designs. So congratulations, Sabrina. You got yourself a slingshot hat. All right. And our last winner of the day, the last bingo winner. Is it you? I hope so. I hope it's you. Let's see if it's you. A DEI giveaway. Shut up, Stanbull. We don't play that game around here. Let's see. Mike R. All right, Mike R. Or maybe it's my Kerr. That makes more sense. Yeah, it's probably my Kerr. My Kerr. And then G's. Miker G's. All right, Miker G's. Miker G's. Let's see what Miker G's has won. Miker G's has won. Where's my giveaway wheel? There. Okay. Let's see what Miker G's has won. My car. See, you won Senior Wahoo's car? I'm just joking. By the way, nobody wins anything except merch. An 80 Delta shirt big. Mike RG's won an 80 Delta shirt. 80 Delta shirt. All right. So for all of our winners, the way to claim your prize is super simple. Just email in to support@outlier.com and April or Cheryl will get your physical mailing address and get that sent over to you right away. So this has been great, right? Remember, whenever you're trading, right, you want to be going with the trend, right? There's all kinds of different ways that you can come up with different plans for trading. But at the end of the day, you're only going to get paid as prices are going up. And that is the number one takeaway from this video, right? You can come up with whatever plan you have, but you have to stick with it with consistency and discipline. You can't trade it in the morning and then by afternoon be like, no, I don't like this anymore. You can't trade it on one stock and it be a loss, which is totally normal, right? Remember, losing is a unavoidable, necessary part of trading, just like winning is an unavoidable, necessary part of trading. Remember, that is the case here, right? And you can't take your first loss and be like, it's never going to work. It's just like flipping that quarter, right? Remember, when you flip the quarter and it has a 50-50% or 50-50 chance of being a winner or loser, that first trade could be a loser. Does that mean your plan is flawed? No, not necessarily. It could just mean that it didn't work out, and that is okay. So make sure that you continue to work on those trading plans. And if you're ready to save time, make money, and start winning with less risk, click one of these two videos. Have a fantastic day.